When Kenya launched the standard gauge railway, it was announced as the tracks for a new economic future. The project was a cornerstone of Kenya's Vision 2030, designed to turn the country into a modern, industrialized hub. The initial plan even went far beyond Kenya's borders. In 2013, East African leaders signed a tripartite agreement between Kenya, Uganda, and Rwanda, later joined by South Sudan. The goal was to create a seamless railway network from Mombasa to Kigali and Juba, linking landlocked economies to the sea and transforming trade across the region. The SGR was expected to be the heartbeat of East African integration, cutting transport costs by up to 40% and dropping freight prices even further. Passenger trains would cruise at high speed, slashing travel time in half. The impact on paper was enormous. The line was forecast to carry 22 million tons of cargo per year, boosting Kenyan GDP. Factories, special economic zones, and new jobs were expected to spring up along the route. Even the environment would benefit. Fewer trucks meant lower carbon emissions. For a region long divided by poor infrastructure, this was the promise of connection, speed, and prosperity. But behind the optimism, some experts were skeptical. The World Bank questioned whether the freight volumes could ever meet the 55 million tons needed for viability. Still, the vision was irresistible. So, in 2017, when President Uhuru Kenyatta launched the Madaraka Express, Kenya celebrated what it called its biggest project since independence. But that was the dream. The promise of prosperity soon collided with the weight of reality. The SGR turned from a national pride project into a financial strain, one that still haunts Kenya's economy. It all started with the cost. For the 472-kilometer stretch from Mombasa to Nairobi, it cost $3.8 billion, about $8 million per kilometer, nearly 3 times higher than the international average. By comparison, Ethiopia's 750-kilometer railway was built for around $3.4 billion. To build its SGR, Kenya awarded contracts to China Road and Bridge Corporation through a government-to-government agreement, bypassing competitive bidding requirements. This arrangement sparked legal challenges from activists and the Law Society of Kenya, who argued it violated national procurement laws. The dispute reached the Supreme Court of Kenya, which ruled in 2023 that the contract was lawful. The court determined that government-to-government transactions fell outside the scope of the Public Procurement and Disposal Act of 2005. Then came the debt. Between 2014 and 2015, Kenya secured $5 billion in loans from the Export-Import Bank of China to fund the first 2 phases of the SGR, covering the route from Mombasa to Naivasha, making it one of the country's largest infrastructure investments. Repayment of this loan would be over 20 years, with grace periods ending in 2019 and 2021. Each year, Kenya spends over $1 billion servicing the SGR debt. As of June 2024, approximately $3.5 billion remained outstanding. And in October 2025, Kenya converted these dollar-denominated loans to Chinese yuan in order to reduce annual interest payments and ease debt servicing pressures. This is expected to save Kenya around $215 million in annual debt servicing costs, especially since late payments this year already triggered around $41 million in penalties. But the real concerns came when the railway started running. Instead of 22 million tons of cargo per year, the SGR moved only about 5 million tons in 2018 and is projected to reach 7 million tons in 2025. By 2020, the project had already accumulated $200 million in losses. To keep trains running, the government had to pay a monthly subsidy of about $10 million to the Chinese operator, Africa Star Railway. Even worse, the network stopped at Naivasha, far short of the Ugandan border, the very connection needed to make it profitable. Without the regional link, the railway became what critics called a line to nowhere. Kenya's government tried to rescue the situation by forcing all Nairobi-bound cargo to use the SGR instead of trucks. This policy disrupted road transport businesses, cost thousands of jobs, and still didn't make the railway profitable. Meanwhile, the debt piled up. SGR repayments drained money from health, education, and development programs. By 2025, 67% of Kenya's revenue was going toward debt servicing, far above safe levels. The SGR had turned from an engine of growth into a burden on the national budget. And as the financial strain deepened, public anger grew. But the story isn't over. Kenya is still fighting to reclaim the promise of the SGR, to turn it from a burden into a backbone of regional trade. The government's new strategy centers on financial restructuring, operational reforms, and again, regional integration. First, debt relief. Kenya is seeking to extend repayment periods and negotiating lower interest rates for its Chinese loans. Second, domestic control. Kenya Railways planned to take over operations from the Chinese firm Afristar, reducing the $10 million monthly payments. However, the full takeover did not happen and has been postponed multiple times, with the latest target set for December 2025. Third, integration with ports and industrial zones. The SGR is being tied more closely to Mombasa Port, the Nairobi Inland Container Depot, and emerging special economic zones in Naivasha. All of it to ensure goods can move seamlessly from ship to factory to market. Kenya is also courting public-private partnerships to finance future extensions as China's lending appetite wanes. Despite its heavy cost, the railway still carries strategic value. The SGR may have quickly transformed into a symbol of debt and doubt, but it still carries Kenya's ambition to modernize, industrialize, and integrate with its neighbors. The dream that began in 2013 is still very much alive. What's your opinion on this? Will Kenya be able to reverse the trend of its SGR project? Let me know in the comments below.